Let's explore whether it actually makes sense to build a more complex ETF portfolio, one that includes up to 6 different funds including specific factor tilts, instead of going with a simple, boring world ETF. After all, the portfolio I just showed you has averaged 2% higher annual return since 1994. That's a big deal. Over decades, it could mean hundreds of thousands of euros more in your account. So it's no wonder many investors are tempted to go this route. After all, we all want to optimize our long-term returns. But is it really that simple? In this video, we'll look at some surprising research from behavioral science, actual investor returns, and even a gym analogy that might completely change how you view this decision. We'll also hear what some of the smartest investors in the world have to say. And by the end, you'll know exactly which strategy is likely to work best for you. The answer might surprise you. If you're new here, my name is Angelo Colombo, and I've been investing in ETFs for over 8 years together with my wife, with the goal of being able to retire early in a few years if we so wish. Okay, let's dive right into the video. First, we need to clarify what we're comparing here. The simple approach is made up of a single global ETF. A FTSE All World, MSCI All Country World, or even MSCI World if you prefer sticking to developed markets. This one fund gives you exposure to thousands of companies spread out across the world. What's beautiful about this is that it's self-cleansing. As companies grow and become more valuable, they automatically get a bigger weight in your portfolio. When companies decline or fail, they naturally shrink or disappear from the index and are replaced by other, more innovative businesses. You don't need to predict winners and losers. The market does it for you. And then we have the complex approach. A carefully constructed portfolio of 6 ETFs that looks like this in our example. 50% S&P 500, 20% MSCI World ex USA for stocks from other developed markets outside the US, 10% each in MSCI Europe Small Cap Value and MSCI USA Small Cap Value, 5% MSCI World Momentum Factor, and 5% in a physical gold ETF for extra diversification and its low correlation. The idea behind this complex approach is optimization. You're trying to capture specific market premiums, small cap, value, and momentum, which, according to academic research, can boost returns over very long periods. There's even a small gold allocation for extra diversification and its low correlation to stocks. And the historical data is compelling. This exact portfolio has delivered about 2% higher annual returns than a simple MSCI All Country World or FTSE All World since 1994, which can make a significant difference due to compounding, as you can see here. By the way, you can find the links to my favorite low-cost brokers in Europe for ETFs down below in the description, which is a great way to support me if you'd like to. Now, when we look at what investors actually achieve, so not what the funds deliver, but what real people end up with in their accounts, the story completely changes. That's because real-world results aren't just about what your portfolio could return on paper. Your long-term returns don't just depend on the portfolio you choose, but on how well you stick to it over time. And that's where things get interesting. You see, behavioral research consistently shows that complex portfolios lead to worse investor behavior, because with more moving parts, there are more decisions to make, more chances to second-guess yourself, more temptation to adjust things during a downturn or performance dip. Take rebalancing, for example. In a 6 ETF portfolio, it's not just a matter of buying a bit more of what went down and selling what went up. You now have to decide between small cap value, momentum, US or other international stocks, and even gold. And what if some of these underperform for years? Will you really keep putting more money into them month after month? The truth is, most people don't. They get discouraged when parts of the portfolio lag. They abandon the plan, and that's where their returns really start to suffer. But investor behavior isn't the only issue. Managing a complex portfolio comes with other costs as well. First, you'll likely be paying significantly more in transaction fees overall when adding money to your portfolio compared to a one ETF investor, plus when it's time to rebalance between the 6 ETFs. Second, rebalancing usually means selling some shares that are in profit and moving that money to the underperforming ETFs to re-establish your target allocation, which means you're realizing profits and paying taxes early, reducing your returns over the long run, as you have less money working for you after the tax bill. And third, you spend way more time managing your investments overall, even more so if you start to question if you picked the right allocation. And here's the thing, you're doing all this extra work, and just like most active fund managers, you might still underperform someone who just buys one broad market ETF and never touches it until retirement. To make this clearer, let's step away from investing for a second. Think about your fitness routine. If you've ever gone to the gym, especially as a guy, you've probably heard of different splits you can use to train each body part. Two popular examples are a 2-way upper-lower or a 3-way push-pull leg split, where you really focus on specific muscle groups each workout. But here's the thing, research shows that you ideally want to hit each muscle at least twice a week to continue making progress. So this means you would need to go to the gym 4 or even 6 days weekly, depending on a split you choose. If you only manage manage to go twice a week on average and sometimes only once, which, let's be honest, is the case for most people, since life often gets in the way and you may have other things you prefer doing that day, your perfectly designed workout system breaks apart and you're not working out some muscle groups for 7 days or more. Now compare that to a simple full body workout. My personal preference at the gym. Each time you train, you hit every major muscle group, covering everything in a single session. If you're able to go 3 times a week as I do, that's great. That still leaves plenty of time for recovery and you can easily rotate between the exercises you do for each muscle. If you're only able to go twice a week, that's also great. You're likely still making some progress as you're hitting each body part twice. And if you're on a trip somewhere or life happens, chances are you can probably fit in a single full body workout that week as well, maintaining the muscle you've built. This fitness routine works because it's easy to stick to. Meanwhile, someone with a more complex workout split is much more likely to get discouraged when they miss training sessions for whatever reason, feeling like they messed up their workout plan and that they failed. Some even quit entirely when it happens repeatedly. Do you see the similarities between workout and investing plans? A one ETF strategy gives you full body exposure within a single, easy to understand fund. You're simply buying and holding thousands of the most profitable companies from all across the world within a single investment, profiting from their growth over time. Each time you have money to invest, you know exactly what to do. Meanwhile, a 6 ETF portfolio is a lot harder to stick to over the long run as it involves many more decisions. Just like being able to work out 6 days a week using a complex workout split is unrealistic for most people. But now let's look at some actual data. A study of German investor returns found that poor ETF selections and market timing are the main reasons investors underperformed a diversified MSCI World ETF buy and hold strategy by 1.69% annually. They argue that unless you have access to privileged information, you're unlikely to consistently outperform a broad market ETF because the wisdom of the crowd should win over the long term. And this isn't just a European problem. Dalbar research from the US also consistently shows that the average ETF investor in the US underperformed their passive benchmark by over 1% on an annual basis over 20 years, mostly because of emotional-driven market timing. They conclude that investment results are more dependent on investor behavior than on fund performance. This behavior gap gets worse with complex portfolios because there are more opportunities to make mistakes. And this isn't just my opinion. Here's what some smart voices in investing have to say. J.L. Collins, the author of The Simple Path to Wealth, a great book I have right here, argues that a single total market fund is more than enough, perhaps paired with a bond ETF to smooth out the ride as you get older. Because according to him, what matters most is sticking to the plan. He argues that the most optimal path is in fact the simple one for the vast majority of investors. In a recent interview, he mentioned that even if a complex strategy could mathematically deliver a bit more, he doubts investors will execute it successfully and that a simple portfolio in the hands of a normal person will thus likely have better actual performance after 20 years. John Bogle, the founder of Vanguard, also always emphasized the importance of keeping things simple by investing in a simple, broadly diversified index. The enemy of a good plan is the dream of a perfect plan. Basically, you need an investment strategy you can stick to. Even Ben Felix, a strong supporter of factor investing, admits that the best strategy is the one you can stick with. All three come from different backgrounds, but they share one message. The best portfolio isn't the most optimized one. It's the one you'll actually follow. Now, I'm not saying a complex strategy is inherently bad. For the right person, someone with a deep understanding of factor investing, tax optimization, and the discipline to stick with it through 5 to 15 years of potential underperformance, it can work. But that's not most people, and that's totally fine. You don't get extra points for complexity. In fact, making things harder can often lead to worse results. So don't let anyone make you feel like a portfolio is too simple. Simple is powerful. Simple is efficient. Simple works when real life gets in the way. If you're curious about my own approach as a European investor, here's what I'm doing. I invest in a globally diversified tax-efficient ETF, the accumulating Invesco FTSE All World every month, no matter what is going on in the markets. If you're following a similar one ETF approach and you prefer another ETF, from Vanguard, iShares, Spider, Amundi, or other fund providers, that's perfectly fine as well. Luckily, there are plenty of great options nowadays. Just make sure it's an ETF that's in line with your investment strategy and that you're willing to hold it for decades. And if sometime in the future a new fund comes along that covers the world more efficiently with lower fees, you can simply add it to your portfolio without the need to sell existing ETF shares, as paying taxes on unrealized profits early would far outweigh any small difference in yearly fees. This simple investment approach has served my wife and I very well since 2017, with our ETFs averaging 10.9% per year so far. I should mention the remaining 10% of our monthly savings going to Bitcoin as a personal speculative bet. It carries significant risk though and definitely isn't for everyone, but I like being completely transparent about what I'm actually doing. And here's the thing, even with Bitcoin, I try to keep it simple, but it does require some rebalancing every year or two to avoid being overexposed to this high-risk asset. We also keep around 6 months of living expenses in a high-yield savings account so that we don't have to touch any of our investments in case of an emergency. So, after everything we've covered, the theory, the data, the expert opinions, what's the takeaway? It's true that the 6 ETF portfolio we looked at today has genuinely delivered almost 2% high returns per year historically, though that's before accounting for higher taxes and trading fees that come with complexity. But here's the thing, the best strategy isn't the one with the highest theoretical returns. It's the one you can stick with through market crashes, life changes, and decades of temptation to change your allocation. If you're the kind of person who loves diving deep into factor research, enjoys tinkering with spreadsheets, and doesn't get shaken out after experiencing years or even decades of underperformance, then the complex route might be for you. But if you're like most investors and you want a strategy that works quietly in the background while you focus on living your life, then that one boring global ETF could be one of the smartest decisions you'll ever make. Just like a full body workout routine beats complex splits if you do it consistently, a simple ETF strategy often beats complex optimization because you'll actually follow it. In investing, as in fitness, consistency beats perfection every time. Let me know in the comments, do you prefer keeping things simple, or do you enjoy tinkering with your portfolio and thus choose a more complex allocation? If you enjoyed the video, please don't forget to gently tap the like button and to subscribe if you haven't yet. You can find my favorite low-cost brokers in Europe for ETFs linked down below, which is a great way to support me if you'd like to. And if you want to know the harsh truth about why so many Europeans are broke right now, make sure you watch this video next. Please don't forget that none of what I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful day, and until next time.